Let's talk about OMCs because OMCs have been leading the PSU rally this year with no major change in fundamentals and largely stable macros. Now, why are they on a tear and is it now time to be cautious on OMCs? Somit is joining in with an analysis of that. Good morning, Somit. Take it away.
Well, as you know that OMCs have been leading the rally in the PSU stocks of late, that is in 2024. But what has changed really for them fundamentally, if you see largely on the GRM side and on the marketing side, the things are pretty much similar. The gross refining margin, that is the Singapore gross refining margin, are largely stable around the $8.5 to $9 per barrel mark, while the marketing margin on petrol ranges in around 8 to 9 rupees per litre, while for diesel it is around 3 to 4 rupees per litre, which is largely the same what it was in 2023 last 3 months. So nothing much has changed for them been seeing, because at the start of 2024, if you see, the valuations of these oil marketing companies were either below or near the historical averages, that is the 5-year averages we are talking about. Now, in case of Indian Oil Corporation, if you see, at the start of 2024, the valuations were at around 6.3, which was at par with its 5-year average, but now the valuations have shot up to around 8.5 times, and it's very near to its peak of around 9 times, that is the 12-month forward P we are talking about. When it comes to BPCL, the valuations were below its 5-year average at around 7.3 at the start of 2024. Now the valuations have shot up to 8.6, which is still below its 5-year averages and in fact below its peak valuations of 13 times as well. And in case of HPCL, if you see, the valuations at start of 2024 was at par with its 5-year averages. Now the valuations have shot up to 6.9, but still below its peak valuations of 8.2. In case of margin of safety, that is the difference between the 200 DMA, 50 DMA and 100 DMA of the stocks to the current market price, Indian Oil Corporation is providing the least margin of safety, because the RSI is not only at 83, but the stock is nearly 75% away from its 200 DMA. Apart from that, it's nearly 59% away from its 100 DMA. Now BPCL also has an RSI of 83 and it's 53% away from its 200 DMA, while in case of HPCL, the RSI is at 71 and it's around 71% away from its 200 DMA. And lastly, when it comes to the analyst view or the consensus view, Indian Oil Corporation is providing the most downside at this moment. If you see the analyst consensus target price, that stands at close to 141, while the current market price is around 174, which suggests a potential downside of nearly 19%, while in case of BPCL and HPCL, the potential downside is anywhere between 7 to 4%. So keep an eye out for all the oil marketing companies, especially Indian Oil Corporation.